guys, it's Doc's Market Minute for Friday, January 8th. All right, we've been sort of following the drama in the S&P 500 and other markets recently as we've started off January with a terrible week, actually the worst one since the 1930s in terms of an opening week to the year. Okay, a couple of things here prevent me from being just absolutely unbelievably bearish at this point with a lower high setting up. First of all, we don't have a lower low yet. So all this is just a big sideways pattern that's brewing with somewhat of a truncated right shoulder on this. So a lot of times we'll grow that shoulder for a while before it actually will break down. We also have a strong trend line that's been in place really since, well, for years now. And those usually don't fail just immediately. They usually don't go failing without some type of a battle at that level first. So here's what might happen in the short term. Now, this is very bearish that we have seen the S&P lose this level, not only the 2000 horizontal price level, but also this declining channel pattern here, right? So this should have stayed within this if this was still a bearish pattern. Typically what we'll see at this point is now that we've broken down below here and below the 61.8% retracement, what we'll typically see is a bounce back up to retest that level from below, and then the next level of selling will kick in. Now, before this reverses and starts working itself materially higher, what's going to happen is the daily chart's going to have to somehow make higher highs and higher lows. So if that does happen, if we punch into 2000 from below, what's going to happen is it'll have to stop its fall, turn around, and make a higher high to go along with that higher low. This is how we'll have to see a change in polarity, right? So there's no mystery behind it. It's just a matter of setting up the levels here that we can sell against and measure to determine what's happening with the price action. What we're also seeing here is exhaustion on the move down. Now, just because an indicator shows exhaustion doesn't necessarily mean that the price has got to stop right there. But typically when the S&P gets down to these levels here, that's around 30 to 25 on the choppiness index, that linearity usually means that initial trend is going to slow down and might even reverse for a few days. So again, we're just playing the probabilities here. We're not trying to predict the future. We're just saying the likelihood of these events occurring is dependent upon all these pieces of evidence that we have that we're putting together, such as measuring trend, understanding linearity of a move, and looking for breakdowns and retests of price levels. Now, the one thing I want to finish on here today is just to draw back on the 2011 analog. So far this has been a pretty accurate version of the 2011 analog where we had a big consolidation pattern after a huge rally here, after the correction, right? So the correction came first, we had a retest of the lows, big rally, consolidation pattern, and then it fell down below that consolidation pattern with a nasty, nasty move. Okay, so that is this year's version. If we go back to 2011, you can see that we essentially did the same thing back then. It doesn't look exactly the same. It's never going to look exactly the same. But out of this consolidation pattern, the price fell down below there, came to the 61.8% retracement, rallied very strongly from there, and then from there it was just a series of higher highs and higher lows as the uptrend went back into full force as we got into 2012. It's possible that the S&P can follow this script and still maintain the uptrend with what's going on right now. Of course, in 2011, what occurred was it bounced from there and kept going higher. So this is what would have to happen for this for the bullish outcome. Would have to very quickly clear this 61.8 and start working higher from here. Maybe it's going to have a reaction at 2000, set up a higher low, needs to have a higher high. It's got to work immediately higher from here. If the price instead does what it probably will do, which is to retest these lows down here from August, then we are setting ourselves up for a very nasty head and shoulders pattern, which has got a target, as we've talked about many times, down near 1600, eventually probably by the end of 2016. All right, folks, that's it for today's Market Minute. Thanks for listening. Have a great weekend. We'll see you back here on Monday.